Good morning, everyone. My name is Tony Diodato. I am a managing director in the rating division for AM Best Company. I thank you for giving me the time to present AM Best's perspective on the insurance industry. Hopefully that comes out loud and clear. Just my brief background, I think my bio is someplace in the deck, but I've been with AM Best for nearly 28 years, another 12 within the insurance industry. The two companies that I used to work for are no longer in existence. And before anybody thinks, no, I did have nothing to do with them being merged out of existence. Being in the industry for that long, I've seen a lot, and I hope I'll be able to share some of the insights that have come across over the years. Today, I'd like to give you just a brief background. I think some of you know AM Best very well, but some may not. So I'd like to just give you a background on who we are, what we do, and how we do it. Then I want to talk about two particular market segments, one being personal lines, which has a lot to do with the homeowners market that is under extreme pressure these days, as well as the reinsurance market, which coincides and has a direct impact on the property side. Talk about some of the pressures that are facing the U.S. property market, and then what some of the carriers are doing, and at the end, I'll open up to questions if you have them. So first, just to talk about AM Best. AM Best is the oldest and most recognized insurance credit agency that solely focuses on insurance. We have other competitors out there, but they do multi-industries. We are focused and dedicated to insurance. And as you saw maybe from the first slide, or if you saw my pin, we are celebrating our 125th anniversary of issuing ratings. It started back in 1899. 1905 was when the first report was issued. And 1906 was really the year where AM Best ratings took off, as that was the year of the San Francisco earthquake. And there were a lot of insolvencies, and Mr. Best at that time was writing reports on which companies were able to meet their claims obligations. We are a global rating agency. We have operations throughout the world. We rate approximately 4,000 companies within 100 different countries. As you can see, we're in London, Amsterdam, Hong Kong, Singapore, Mexico City. Those offices all have analytical people following specific areas of the world, and we do have a representative office in Dubai. So as you said, we report on over 16,000 companies throughout the world, and I'll refer to the three I's of which distinguishes AM Best and what our process does. It is an independent opinion of an insurer's ability to pay their claims and their financial obligations. It is indicative. It is to look to see if they're going to be able to pay their claims in the future and their financial obligations. And it's interactive. We only put ratings on companies that want to sit across the table and have a discussion on their current performance, their past performance, and how they see their future performance evolving. So it has to be interactive for us to continue our rating relationship with the company. And as I said earlier, we focus only on insurance. We have an expertise. We have employees, analysts that come from all different insurance backgrounds. Many of them work for insurance companies. Some are actuaries, claims adjusters, underwriters, various disciplines within the insurance industry, and we continue to hone that expertise. This is a schematic of the way the process works, and obviously it starts with data. A lot of the information in the U.S. comes from the statutory blank. We take that information. We also look at GAAP filings, but as I said, we're a global agency, so we take whatever the regulatory format is, and we have a process. We have a data center that brings it all together, provides various reports for the analytical teams to analyze and to go over. The analysts will perform detailed analysis based on that information. based on the interaction of how the company did in the prior year or the current year, and how they see market conditions affecting them going forward, and how they're going to cope with a changing environment. Once that is concluded, it goes to a rating committee. The rating committee decides what the final rating will be published. Although an analyst will do the analysis and perform the detailed conversations with the company, it is not an analyst who makes a rating decision. It is the rating committee. It is the way it is more exposed to different levels. So it's not just one person. There's experience level from anywhere from old folks like me with 28 years experience to some junior people that have about a year experience. All different types of knowledge is being put into that analysis, into that final decision. We disseminate it through our website, available to anybody who goes there to look at what the rating will be. And it's an ongoing process. We don't just do the rating and let it sit for a year. As you all know, the industry changes, events happen. Example last week was Hurricane Francine that came across. We're in contact with our companies after a significant event. We look at quarterly filings, annual filings, press releases, and we'll have conversations if there's something that's material, even if not. If a company's working based on what their plan and what they explained to us what the year was going, we just call them up and acknowledge what they're doing. So it's not always a bad conversation or a phone call you get from AM Best Analyst. So just to maybe elaborate just on the process. So it's not just one number that we look at. There's there are, as you can see from this schedule or this exhibit, there are many facets that go into determining a rating decision. We start with balance sheet assessment. We look at the capitalization of the company. We have our own capital model called Best Capital Adequacy Ratio that takes the financial information. We have risk factors based on that information. We come up with a number similar to what an RBC calculation is, but a little more interactive. But that's the starting point, because balance sheet is the foundation to pay claims today. So that is the anchor when we look at the analysis. And it's not just looking at our capital model, it's looking at other metrics that affect capitalization, such as leverage, the utilization of reinsurance, the dependence on reinsurance, so forth and so on. So there are numerous. And all this information is on our website, so I'm going to go through this at a very high level. But if you have questions after the presentation, please reach out to me, or that information is available on our website. So as I said, balance sheet is the starting point. And after that, we look at operating performance. If you could see from hopefully you can see that, there are brackets underneath operating performance. It could be +2 or -3. Operating performance allows the company to pay their claims in the future. So you're building based on your operations to provide stability to pay claims in the future. So in that bracket, it could be, if you're outperforming your peers in the industry, you can get what we refer to as 2 notches from the starting point. Or if you're operating at loss, you can go down 3. And once again, typically in the U.S., you're not going down 3, but in emerging markets in the Middle East, in Latin and South America, there are cases where we do have to go down multiple notches. Those 2 are very quantitative. As I said, there are different metrics that we look at and that could be analyzed. The next 2 are more qualitative, so we do put a limitation on the notching up and down that we would give to a company based on those categories. One is business profile. Business profile encompasses a lot of different factors. Some of the things are just how an organization is managing through their jurisdictions, how they're operating. Do they have a competitive advantage that allows them to do better than their peers? How are they combating against their peers? How are they coping with that? Do they have a competitive advantage? Now, business profile does not mean you are on TV with your national ads that we all see all the time. There are many regional companies throughout the country that have a competitive advantage, either based on distribution, product, that allows them to have a favorable business profile. Enterprise risk management, how are you coping with the risk? Risks are changing daily. We all see it, and it's not just weather. There are different factors that I'll talk about a little later that affect companies' ability to manage the risks, protecting their balance sheet, allowing them to operate profitable, and sustain their rating. So those are the factors that main factors that we come up with. In 2018, when we released this schematic of how we do our process, we recognize that in the world is always changing. We put a category called comprehensive adjustment. We've never used it, but we wanted to have so to speak, a safety valve. If there was something that did not fit in those other categories, we wanted to have something, but we feel very confident up to this point. We haven't used it, we're not going to need to use it, but it's there. Now, if you're just a standalone insurance company, that's where the rating process would end. If you are a small niche player for a national or global writer that may be supporting you either through underwriting expertise, risk management, capital, we may increase or decrease a rating based on the holding company or the parent's financial ability to support that operation. After we go all through that, we come up with a final rating which is released to the public. So now we'd like to spend a little time just talking about market segments. When we look at market segments, we're not just looking at the current environment, we're looking at what we hear from companies and from our research, what the future may look like based on competitive as well as economic conditions. We also look at the regulatory environment. And yes, there are some states, not all, that are more difficult from a regulatory environment for companies to develop. Once again, global type ratings, we have organizations that are in difficult regulatory environments. We do ratings in South America where inflation is 20, 30%. So we have to factor that into our analysis when we look at what a rating is or what the segment is. We look at the terms and conditions that are going on for that particular segment. And we put them into three different buckets. The outlook for the segment could be positive, negative, or stable. Excuse me. But an important distinction is just because a segment may have a negative or positive outlook, that does not have a direct correlation to what an insurance company's outlook can be. If an insurance company is able to manage through the process, manage through a difficult economic and competitive environment, they could still have a stable or a positive or upgrade. So there's a distinction between what a segment outlook is and what a rating outlook is. So let me jump into personal lines with a slant towards homeowners' property exposures. There has been ongoing volatility both on the auto, but particularly on the homeowners. If you're following the market, which I presume everybody in this audience is, you've seen what the volatility is from performance over the past several years. Catastrophes have a big element of that, but there are other issues that are affecting the property writers, such as rising loss costs, severity, frequency, inflation, challenging the regulatory environment and get rate increase and to get them implemented. Reinsurance costs, which will be the next segment I'm going to talk about, have increased, and company managements are faced with that dilemma: do I pay extra for the reinsurance, or do I keep the risk on my own books? And that, although it's not the only element, there has been a dramatic increase in frequency and severity of events. I'm not a scientist, I'm not a meteorologist, I'm not going to try to explain it, but I do have some slides that show that there has been a dramatic increase. It's not all bad for the property writers. They are well capitalized based on various metrics of looking at the PCAR, our PCAR model, looking at underwriting leverage, looking at their ability to increase capital. So there is a favorable element for the property writers. They are, to the best of their ability, trying to push right through. And when I say that, it's not to be over profitable, but the risk factors have changed. So they're trying to get the rate to be commensurate with the risk that they're underwriting. Investment markets have gotten better. During the pandemic, we all saw that interest rates went down to zero and stayed there for a very long time. Now the markets have changed. They're much higher as far as investment yields. That helps offset some of the volatility and some of the underwriting losses that the industry has been experiencing. There has been an increase in innovation and digitization within the personal lines, the homeowner section. They're becoming more efficient. They're slicing and dicing the information and be able to look at risk in a different way and not just broad brush all risk and all customers. And with that, they're able to refine their risk management practice, which reduces the volatility and puts them in a better position to make underwriting profitability. So the global reinsurance. In some ways, they've been pointed out as the bad element with the industry because they're raising rates and restricting terms and conditions. But for a long time, the reinsurance market had been operating, for the most part, at a loss. Term that is usually used is that they weren't meeting their cost of capital. They have to increase their capital, and sometimes they're borrowing money, and the interest rates were arbitrarily, say, 10%, and they were making 7%, so they were in a losing situation. So as they looked at their books of business and where their losses were coming from, they made a determination to increase rates and reduce their exposures to the primary companies, most of that being on the property side. There has been a great demand, so property writers are looking to get the coverage that they once had. That coverage was protecting the underwriting, the combined ratios of the primary companies at the offset where the reinsurers were taking a lot of those frequent and less severe events onto their balance sheet and onto their performance. So you had an ebb and flow. You had a win-lose for the industry. The primaries were winning because they had the operating performance protection because the losses were being passed to the reinsurers, and the reinsurers were then taking that. Now the dynamic has changed where you have the reinsurers are being more restricted. They're practicing their ERM. They're looking at their exposures, and they're pulling back or increasing rates. One of the devils of the industry is when you have too much capital, you lose your underwriting discipline. And through this current cycle, we have not seen new capital come in on the reinsurance side. Discipline has remained strong, and they have been making favorable returns. The one thing that has been an impact to the industry, which affects mostly on the commercial lines and the reinsurance, is social inflation. I'm sure you all read about it. I have something on it a little later. But there's been an increase unknown from jury awards from that aspect that is not being priced that has impacted the industry, mostly on casualty up to this point, but it's something that has to be monitored. So when we look at it in totality for the reinsurance segment, it is a positive segment at this point. The elements of economic and competition we do see being sustained. We just moved it to a positive a few months ago. We look at it at least annually, so it's not to say it's going to last forever, but right now we do see that segment having a positive outlook. All right. So let me just go into some of the elements again. Everybody hears about property, or catastrophes, and I can't not talk about it, but that is the number one when you look at this slide. The elevated cat losses, once again, I can't go into details why it is. I'm not going to say global warming or what the impact is, but when you look at the results, and I'm going to show you shortly, there has been a dramatic increase in frequency and severity of storms in the U.S. Secondary perils are the ones that are modeled, but they're not easy to model. The firms are continue to refine their way, the way they look at them, but it is not as predictable as a hurricane. There's 100 years of data of different hurricanes that have come up the coast or into the Gulf excuse me, and have impacted the industry, and they can make some predictions based on that. However, if you're working with companies that are in the Midwest, tornadoes, convection storms, tornadoes bounce around. We've all seen pictures over the years of one house being destroyed and the house next to it 2 blocks down not being touched. That's harder to predict from a modeling point of view. So those secondary perils, another one being wildfire. It could be in one location, embers get into the air and go down a mile down the road and start another fire. Those are very hard to predict from a modeling point of view. So the uncertainty with secondary perils has increased and has a dramatic impact on the property writers. As I mentioned, reinsurance pricing has gone up. So there's been certain very difficult decisions made by insurance companies' managements. Do I pay for coverage that I may not use? Or do I continue to look at my book of business and refine it to have the rates be more commensurate? So the pricing of reinsurance, timing of terms and conditions have affected decisions and has increased homeowners and property writers' exposures over the past several years. There are hurdles, as I said, with certain regulatory environments. The process to put a rate increase takes a lot of time for an insurance company. The regulator has multiple companies, 100 companies with their looking at filings. It takes time. Once it's approved, if it's at what they requested, it takes time to implement it. It's a 12-month policy. You put something in, it could take 18 months to 2 years for the benefit of that process to come through. So if there are delays or the companies don't get the rate that they think is commensurate with the exposure, there's always going to be a gap. Some companies, because they have to increase the retention, which puts more volatility on their books. To reduce some of the costs, they take what they call a sliver on the side, where they may participate within more exposure, so-called having skin in the game. And it's another way to try to mitigate some of the reinsurance costs, but it does put more exposure on the companies. So if you're having those frequent storms, those increased frequencies and severities, it's having more impact on the operating performance. Inflation and rising loss cost, it's throughout the industry, throughout our day-to-day lives. We all see it. We know inflation's going up. And we'll hear later in the week if it has come down enough for the feds to reduce interest rates, but it has had a dramatic impact on property writers. Pictures always say a lot, so I have a couple slides here just to reinforce the fact of what's going on with the U.S. homeowners. As you can see, the combined ratios for since 2013 through now, 6 of the last 7 years, they have been operating a combined ratio greater than 100. Very elementary. If you're 2013, if you're writing a $100 policy, you're paying out $110. So you're losing $10, almost $11 for the U.S. property market. So there has been just a dramatic increase in the combined ratios, especially the last 6 to 7 years. This chart is another good one. I think it illustrates, you can look at combined ratios, you can look at different numbers, and I could go on and on about what the profitability or the losses have been, but I think this is a very dramatic illustration of what the industry is grappling with. As you can see, from 2015 to 2023, the industry has lost about $44 billion of homeowners' losses in the U.S. market. And although things are improving, we do think there's going to be another $10 billion loss for 2024. So we're looking at about close to $55 billion losses in the homeowner market. So there is a dramatic impact to what is happening in the U.S. on property exposed business. And as I said, I'm not going to try to explain it because I can't, but this shows that the large losses over the past several years has dramatically increased. There's a low period from 2003 to maybe 2010, but you can see there's been some ups and downs, but the last few years there's just been a dramatic increase what property exposed business has to deal with. One last slide on the property and then on the cats, and then I'll get off that, but this is just another illustration of 2023 frequency and severity events, and there's different events from 2020 to the current year, and you can see that 30% in the last 10 years of large losses have happened last year in 2023. Okay, switching off of cats, because I know everybody's tired of hearing about property and losses and weather. This is another visual that shows why homeowners particularly are dealing with a lot of issues. And this is not something that I think surprises anybody in the audience, but you can see from a material point of view, cement, labor, dramatic increases, saw the spikes, the ebbs and flows around the pandemic, but they're still very elevated for both these materials that go into fixing homes. You know, you have that loss. This is why pricing within the industry is going up. And on the right, wage costs. Similar scenario where there's some changes pre-pandemic and then post-pandemic, but they're still very elevated. So when we talk about economic conditions, we talk about inflation, it's not just insurance companies trying to get more rate. The cost to repair homes has dramatically increased. So the impact of the weather is also complicated or exacerbated by the inflationary costs. And once again, reinsurance cost. If you've been in the industry long enough, you know 1992, there was just one major hurricane, that was Hurricane Andrew, that devastated Florida. And there was a significant spike in reinsurance costs around that time. And there's been other ebbs and flows, the tragedy of September 11th, hurricanes, Katrina, Rita, and Wilma, you see spikes along the way. But then you can see that ebbing where it's gone down for a number of years, and now in 23, 24, or 22, 23, 24, the prices are going up on the reinsurance cost. Again, it's not just reinsurers trying to take more money. They're looking at their risks. The risks are getting more complicated. The risks are evolving, and they're charging rates that are commensurate with the risk that they're taking on. I've said it many times, so I'm not going to spend a lot of time on this, but the reinsurance has been evolving. And for a primary company, they were laying off that risk, and it was cheaper. They were arbitrating cheap reinsurance, getting the operating performance protection, and the reinsurers were happy to oblige. And now that has changed. It is no longer cheap. It is very expensive. Reinsurers are saying, yes, I'll write your business, but you're going to have some skin in the game. You're going to have some participation in it, or the terms and conditions are going to be high. We have to make sure that we're protecting their balance sheet as well as trying to provide a service to the primaries. There had been, for a long time in the industry, aggregate covers where the reinsurers would take those low or the frequent events into consideration. They've tightened terms and conditions. They still exist, but the pricing is very high. So many primary companies, homeowners, exposed companies are not taking the coverage. Once again, just another illustration on how from a homeowner's insurance premiums, how it's changed over the years. There has been a dramatic increase of trying to get the rates to be commensurate with their exposure they're taking on. The atmosphere has changed, the world has changed, and the pricing is trying to catch up to what that change is looking like. As a regulator, you understand that you're challenged with trying to balance affordability and availability of coverage. At AM Best, as a rating analyst, I'm not looking at the affordability or availability. I'm looking at to see if you're filing a claim, are you going to get paid? If you're lending money to this insurance operation, are you going to get paid? That's what an AM Best rating is doing. We understand the challenges as a regulator that you're balanced with something else. Is it affordable? Is it available? And what the ramifications are. As I said earlier, some of the challenges that insurance companies have is once they recognize a rate need, they make their filings, they submit it. There's a process that regulators have to go through to approve, to understand what they are. It could be 12 to 18 months, 24 months before that there's a tangible benefit to the insurance company's operations and therefore their balance sheet, the ability to pay claims before that takes effect. When we look at business profile, I said this earlier, one of the many elements in business profile is the regulatory environment that companies operate in. Are they working with a regulator that is open to the changes in how rate increases are necessary so they could stay viable in their market? Or is it more difficult to get the rates? We've seen it all throughout the country. There are some that are more difficult to operate in. And it's not to say that we look at a state and say, well, you're operating in this particular state and that means your profile is -1. No, it's not that simple, but it is something that we would take into consideration when we look at someone's business profile. So earlier I talked about social inflation, and I'm not going to read everything on this slide here, but I think you'll understand, again, this is not an AMS, this is information we took from a consulting firm. Social inflation and injury awards, and you can see that there's a lot of mistrust of corporate America with the average consumer. They feel that profits come before safety. They don't believe that there is a genuine consideration for the average consumer. Many cases, juries ignore what a judge will say, what the awards guidelines are, if they're so to be. And jury awards are coming in higher and higher. The so-called nuclear verdicts over $10 million have dramatically increased over the time. And right now, this is an element that is more on commercial side, which affects reinsurers. There are elements that are starting to impact more on auto. We haven't really seen a dramatic increase in homeowners. Maybe you have. But it is something that is an emerging risk that property writers will have to deal with in the future. Part of social inflation comes in an element called litigation funding, which again, many of you have probably read about this. But what happens is you have investors that are funding law firms that go out and say, go find and issue class action suits. They go out and are very aggressive, and they make that social inflation element increase dramatically. This next slide, I think, is very eye-opening when you look at it. Here are 5 different industries of where returns have been mapped out. Again, this is not AM Best data, but you can see you have hedge funds that are really on the low end here of this very small scale. But away at the end, you can see litigation funding has the returns greater than I would have thought for hedge funds or private equity. So it is something that very prevalent in commercial lines, which affects the casualty reserves. You can't price for this. This is an element of unknown that insurance companies are dealing with, but it is something that's live and it's happening. And if it's happening throughout the industry, throughout different parts of the industry, it may come into the property side sooner or later. And from your experience, you may have already seen some of this, but it is something that is evolving and something that needs to be watched. So what are carriers doing? You shared a lot of difficult things that are going on, but companies are not just saying, I'm going to take rate and see what happens. One, they're being proactive. If there's outside money, if it's a holding company, a wealthy parent, or a financially sound parent, they're infusing capital into the entity to make sure that it has that stable balance sheet strength. Some companies are being active and looking to lease back their buildings, again, raise more capital to sustain their balance sheet strength. We do see a slight uptick with regional players for mergers and acquisitions, spreading your risk. If you're geographically concentrated in New England, you might want a property writer in the Midwest and balance the different type of exposures. There is a drive to get more quota share reinsurance, again, more protection, sharing the risk. Reinsurers would be glad to do that if they feel that book of business is performing well. They'll lay off some of the exposure, so we do see some quota shares being picked up. And if you're don't have a wealthy holding company involved, we do see some of the regional companies acquiring surplus notes. Again, they want to fortify their balance sheet proactively, even if they have not had that property exposed business happening to their balance sheet. They're proactively looking to put more capital in for that rainy day. So how does it affect the elements? If you remember earlier, I had the balance sheet, operating performance, business profile, ERM. These are some of the things, again, that we see insurance companies' managements implementing. Rate increase, obviously, is one we've talked about a lot. Putting inflation guards in place, so as inflation goes up, excuse me, it's automatically kicking in. Tightening underwriting guidelines. We do see companies looking to refine their book, looking what their exposures are. The exposure refinement, again, we can't be over-concentrated. It's good risk management, ERM practices to look at what your business is. Back to the underwriting, we do see companies that are moving from a replacement cost to ACV coverages and explaining that. They're also looking at increasing the deductibles, putting that option out there, going from a 1% deductible to maybe 2%, or just increasing the baseline. We do see companies doing that. And in management is looking at their agents, looking at which ones are giving them profitable business, looking at what exposures they're bringing on their books, looking at it over a time period, maybe dropping agents or reducing agents' commissions. Once again, I think I touched on a bunch of here, but one of the things or two things on the bottom I would talk about would be bundling. We can't hear a commercial where someone's saying you got to bundle your insurance, will save you money. From an insurance company, it does save money. There is a stickiness to, if you have multiple policies with an insurance company, you're probably less likely to shop. It diversifies the exposure to the insurance company, because if you have a loss on the property, but your auto is fine, your umbrella is fine, it gives them a benefit there. And we do see many of the homeowners property companies looking to expand their business to do small commercial. There's better performance in different areas on the commercial side. Easier to get on and off business if it is unprofitable. So we do see companies proactively looking to change their footprint, looking at different types of business. So they're being active in looking for ways to improve the performance and reduce the volatility. So there is a light at the end of the tunnel, and it's not a train coming to the industry, to the homeowners writers. There is some positives happening. We do see that there has been a movement to get rates to what the risks are. Again, I'm not an actuary. I'm not going to try to say what they should be or shouldn't be. But based on exposure and performance, we do see that that is migrating to an area where you're not going to be paying $110 when you're only charging $100 on a premium. Investment yields, as I said earlier, the returns are better. Stock market, there's volatility, and I'm not an equity analyst, so I'm not going to predict if it's going to stay up or go down, or if the Fed is going to drop rates later this week. But for now, they have increased. It has been an offset as companies refine their pricing that are able to get risk-adjusted rates. Combined ratios are starting to get into a normal, predictable pattern. The investment yields have allowed them to maintain or improve their capital because they have the offset. Once again, I'm not an economist, but inflation seems to be coming down if you believe what the Fed is saying. It's not where their target is, but it seems directionally moving in the way they want it. We'll find out later in the week if it's enough for them to drop rates. And a lot of predictions, if it's 0.25%, if it's 0.5%. I was having breakfast with someone this morning, and they didn't think it was going to drop at all. So if you want to put bets on later, I'll be in the back of the room. I have no idea. Technology. Once again, the insurance industry has not been leading the world in technology, but it has made a lot of progress, and it continues to invest in technology, in innovation. And innovation is multifaceted. You know, we all think innovation, we're thinking technology, we're thinking of slicing and dicing and looking at exposure, but innovation for an insurance company is also looking at the products that your customers want. And are you being active in giving your customer what they want? Are you being innovative in looking at products that meet their needs rather than just the standard boilerplate? And that's technology, that's innovation. We see property writers being more active in doing that. No offense to our regulators in the room, but it's just a fact of life in personal lines, homeowners. It is a highly regulated industry. And once again, I go back to the earlier comments. You're balancing the affordability and availability of insurance to consumers. And that's a difficult task to do. But that has a direct impact on companies and their solvencies. So there is a light, there is a hope. Yeah, we do, from my earlier slide, we do see that the industry's profitability or loss will improve for this year. We think we haven't gone into our crystal ball for 2025, but we think the trajectory and the trend is headed in the right direction. It's never going to be the most profitable line of business. Homeowners, there's always going to be volatility. There's always going to be pressures, but we do see that to where it is more even keeled, where the industry is not losing close to $55 billion in 5 to 10 years, where it's more break even. So with that said, I am done rambling. I will not talk about property or cats or anything like that unless someone brings it up. But we do have a few minutes left if anybody has any questions that we'd like to throw out. Okay. Well, I thank you for your attention. I thank you for letting me talk about AM Best. Enjoy the rest of your conference.